Okay, this is the part 3 of the financial statements. This is the continuing lecture from the balance sheet, which was the segment, a previous segment to this section. Now, so we finished all the, since we have finished all the discussions about the income statement and balance sheet, now our next exercise is what they call vertical analysis and horizontal analysis. Now, vertical analysis is actually not a very good, I don't think it is a very good name, but that's just the way they call it. But I would like to call it, when it's common size, another name for that is common size statement. Common size statement means you putting the balance sheet in line items in terms of the size, in terms of the percentage, as percentage of the total assets. So to do this, we will need to basically simply express every line item by the we can express every line item by the percentage, right? So this percentage column is something you have to find out, which is very easy, which isn't really difficult, right? So now let's think about it. Let's think about the reason they call this common size statement. It's called common size statement because regardless of the size of the total assets or the size of the company, right, you can use the you can easily compare how big each line item in the balance sheet is in terms of the size of the total assets of that company. So let's take a look at this example. You got to go to the further exercises bottom tab. Of course, the first thing, it's very easy. All you need to do is, finding total current assets. We did this before, so all you need to do is just, auto sum, right? And then total non-current assets, also auto sum, right? And then the total assets is simply the sum of those two. I'm sorry, that and that. It's not very difficult, right? And then again, and then also again, since they are, I will contiguous data range, you will just, and then total liabilities, of course, then is the sum of total current liabilities and total non-current liabilities. And there you go. Now our next question is, how do we know what equity is, right? Well, that's not a difficult question because by definition, the balance sheet must be balanced out, isn't it right? And the balance sheet is the accounting equation is total assets equal total liabilities plus equity. So that means since total assets is equal to, right, this plus this must equal to this. So then this minus this will be the equity, right? So all you need to do is this minus this, and there you go. And then total liabilities plus equity is, and uh, sum of those two numbers, and they are balanced out. Okay. So next, we must express this in percentage, right? Percentage of what? The percentage of the total assets. So we're going to divide it by this, right? Total assets, not total current assets. And again, I will copy and paste this all over. But to do that, then I should lock B13 because without locking it, right? And you know how to lock it. Hit F4, and it's going to automatically lock it. Because if you don't lock it, as you go down the row, in the second row, it's going to be B5 over B14. It's going to be B6 in the row 6. It's going to be B6 over B15. In other words, the denominator will move, and you can't allow that to happen because the denominator has to be always the total assets. So it must be locked in B13. So that's why you do. That's why you do lock it, right? And once you do that, and then I can drag it down, right? I can drag it all the way down. Okay, there you go. So then one thing you need to do is that you need to clean up, right? The cells that don't have any data, the blank cells that don't have any data, right? If you don't think about it, there's nothing there, right? There's nothing there, nothing to be, so you delete. You have to complete, you have to clean up the excess garbage, right? The garbage. That's garbage, right? So once you're done, now think about it. Suppose you have another balance sheet of another company, and another company has obviously will have different total assets, different capital structure, right? Different debt and equity. So then you don't know. When you're comparing two companies, just the sheer numbers alone wouldn't give you a good picture about this company. For example, in this company, you can easily tell, well, out of the total assets, the non-current assets are 51% and current assets are 49%. You can tell, you can compare that with the other company. I mean, this doesn't seem like a manufacturer, because if it is a manufacturer, it would have a huge fixed assets or non-current assets proportion, right? If this is a manufacturer, and if this is average level of non-current assets or physical assets for that industry, then this company has pretty good liquid assets or pretty high cash flow, right, compared to its total asset size, right? But what kind of manufacturing would have just about $240,000 physical assets? That would, as a manufacturing, that would be Um, Not even I know, candle making, maybe, right? Not even candle making. Maybe if you are uh, making just clips, right? Paper clips. Maybe this would be the size of your plant and equipment, right? The building and plant and equipment, right? Otherwise, this doesn't look like a decent manufacturing, right? So, and you can compare how much is what proportion of the total assets is equity and what proportion is liabilities or debt. Look at this company. It's got only like 17% equity, right? Uh, and 83% debt. So this is just from this, you can tell this company's capital structure is too much into debt, which is what? This company is very risky, right? This company is very risky. Why? So much debt, right? 80% debt, and not even 20% equity. All the earnings of the company will be most likely be exhausted in paying for uh, the interest expense, right? Or debt servicing. And that means, you won't have any net profit left over. You may not even have any uh, operating, you may not have any EBT, earnings before taxes, right? Uh, and then if you don't have any EBT, of course, you won't pay taxes. But, that's not a very good thing, right? You don't run any business just to pay for the interest, right? You must have uh, you must have net profit, right? So this picture, I mean, by common size statement, right? You can tell a lot of things about this company. This is called common size statement or uh, vertical analysis. Now, let's go down to the next example. Next example, I want you to clear out, I want you to delete everything in columns D and E, and also delete all the highlighted cells. Okay. All the highlighted cells. So what are we doing in this example? Now, look at, first of all, you can tell this is balance sheet, right? And we're looking at the balance sheet of 2009 and 2008. Okay. So this is more like, end of 2008 and end of 2009. And I've been telling you that you need two balance sheets and one income statement, right? Two balance sheets mean, balance sheet at time zero and balance sheet at time one. So this is like balance sheet at time zero and balance sheet at time one. So uh, why? Because you want to know how much has changed, right? How much in each line item uh, the company has changed. So you are in column D and E, you want to find the change. In other words, increase or decrease, either increase. Increase is positive change, decrease is, of course, negative change. And we want to find that in both amounts, dollar amount, and in percentage. Of course, first of all, in dollar amount, in terms of dollar amount, you subtract the previous year from the current year, right? So let's make this 2009 was like 10,000, 10 years ago. So let's make this 2019 and 2018. Okay. Of course, you'll have to take this away from this, right? I mean, that's how you measure change. And then the rest of it is simple, because it's the same thing, you'll just simply drag it down, right? But then you might wonder, I don't have this. Don't worry. Look, total current assets, we know what that is. There you go. And you can simply drag it to the right, and the same formula gets copied, right? And we had it there already. So, and then this is the gap, right? It's just space, right? Empty space, right? There's no data there, so you simply clear it out. So here, the formula is already in there, but what does that mean? There has been no change, right? And then also non-current assets, just auto sum, right? Use auto sum, and you just copy to the right. And total assets, then, that's the sum of total current and total non-current assets. Okay. Enter. And you can drag it to the right. Okay. And there you go. We got that. And these two cells are blank. So no data there. You get them out. You just take them out. And here we know current liabilities, total current liabilities. All you need to do is just auto sum. And there you go. There has been no change in total current liabilities. Now, non-current liabilities, we do the same. Okay. Now, then total liability is what? Sum of these two. Right? Sum of those two numbers, right? And, oops, what did I do? B47. Oh, sum. I forgot to complete. Okay. Now you just copy it to the right or drag it to the right. And then just get rid of the blank cells, right? Now, how do we find equity? Well, we know already. It's the difference between total assets and total liabilities, right? So we get that, right? And then total liabilities and equity, just the sum of these two numbers, right? And drag it to the right. There you go. What about this? You can just, drag it down. Then we have we found the changes, right? So that means negative change, of course, because cash decreased by 2,000 between the 2 years, but securities, marketable securities like stocks and bonds, increased by 2,000. Accounts receivable increased by 6,000. inventory decreased by 4,000, and so on. We can, interpret that. But actually, whether interpretation doesn't stop there. You should do some analytical thinking. I mean, is that increase good or bad? Is that decrease good or bad? You might think all the decreases are bad and all the increases are good, but it's not that simple, right? Some things are counterintuitive, but we will basically get to that. We will talk about that after completing our table. So percentage changes. Think about it. There was $2,000 decrease from the base year. Think about it. The base year is you're comparing it to the base year, isn't that right? So the decrease of 2,000 over, right, the base year amount. And since I put already, formatted it as percentage, it's going to be all, it's going to give you automatically the percentage. And because it's all, it's all the same thing, because you drag it down, because it is this divided by this divided by this, you just, same formula, you just drag it down. And then wherever there is no data, you'll just need to clean it up. You just clean it up, right? Clean it up, clean it up, clean it up, right? Clean. And then I'll just keep it neat by, giving it like, uniform, consistent borderline, right? And the borderline makes it clearly, gives it some, structure, right? Now, so what is the interpretation? First of all, cash decreased by 2,000. And my question is then, is this a good thing or bad thing? Mm-hmm. No, most of you would say that's a bad thing because cash holding decreased. Look, that's not a bad thing. That's not a bad thing at all, right? What is important is how much did the total assets increase and how much the total current assets increase. What does total current asset mean? That means liquidity, cash flow, right? These are all liquid assets, right? They can be easily converted into cash, right? So cash is not liquidity. Cash flow is not only cash, right? Cash flow is not only cash. As long as your liquidity or cash flow has increased, then that's the positive thing. That's what you have to look into, not the not the cash itself, not the cash holding itself, right? Okay. Why? Think about it. First of all, cash, if you're holding too much cash, right, more than the necessary level, cash doesn't earn anything, right? Cash doesn't earn anything. You put your money in the, how do you hold cash? In the checking account. Of course, you don't hold cash in your wallet or in your pocket. I mean, if you're a company, of course, you would hold cash in the checking account. Of course, you would hold some in the company's safe, right? But most of it isn't. And no matter where it is, cash doesn't earn anything, right? But cash loses value due to inflation, right? If there is, if the economy is booming, then there would be, a decent level of inflation. And so if you have too much cash holding, it will lose value and doesn't earn anything. So what's important is increasing the liquidity of the company, right? Cash flow of the company, not the cash holding. Now, instead, um, look at the marketable securities like stocks and bonds. Look at stocks and bonds. It increased by 2,000. And what do the stocks and bonds do? What is the meaning of that? They stocks and bonds give you interest income or investment income, right? Sometimes it can give you a negative return, but they give you return on investment, right? So when marketable securities holdings increase, then that's a good thing. That's a positive sign, right? Positive signal. Now, but we can also tell that all that cash decrease actually went into marketable securities. Isn't it right? There was a trade-off. So this decrease in cash is not a bad thing. It's a good thing, right? You don't hold too much cash, unnecessarily too much cash that doesn't earn anything. Instead, you put that cash, changing cash into the securities, which is actually earning something. And what about accounts receivable? Accounts receivable increased. What does that mean? That's a good thing. Why? Because that means sales, right? This is revenue, right? Accounts receivable means revenue. Of course, collection is next question. How fast or how uh, expeditiously can you collect, right? Uh, that accounts receivable. That's the question. But anyway, this means increase in sale. Your sale increased by 6,000 or even 6 million. I mean, if everything, all the numbers here are in thousands, right? $1,000. This means, millions. Everything in thousand here is million. So look at the total and look at the inventory. Inventory went down by 4,000. So what does this mean? This is a good thing. You made all these inventories were sold, right? If they are all finished goods, they got sold, and they contributed to this increase in accounts receivable, right? Now, eventually, the total current assets increased by 2,000, right? So that was a 3% increase, 3.17% increase in your working capital, right? Of course, that's a good thing. Now look at the fixed assets or physical assets or real assets, right? Land, no change, okay? Building increased by $10 million or, 62.5%. So the company acquired more building, which is asset. It's a good thing. Equipment, production equipment increased by 3,000 or 16.67%, also a good thing. So total non-current assets increased in total by 18.06%, and your total assets increased by 11.11%. So overall, right, positive signal, right? Positive signal. Why? Because size of this means total asset size increased by 11.11%. That means your company's size increased by 11.11%, which means when your company's size increases, what does that mean? It can mean, total non-current assets increased by almost 20%. What does that mean? If this is all plant and equipment, right? Your production capacity increased by 20%. 20% increase in production capacity means your output will increase by 20%. 20% increase in output means 20% increase in sale, right? Sales revenue. 20% increase in sales revenue also means you are increasing your market share by as much. So all in all, uh, increasing the size of total assets translates into increase in sale, increase in output, also increase in market share, right? And increase in size of the company. A size of the company means not just the physical size or dollar value size, but it also means, more capability, right, of the company and more presence, right? Bigger presence, higher presence, more visibility in the market because your market share is increasing, right? Okay, so that's all, a lot of positive signals there. Look at the current liabilities. Current liabilities increase, accounts payable increased by $2,000. You might wonder if accounts payable increased, that sounds like a bad thing. No, actually, from the cash flow perspective, it's not a bad thing. Why? Accounts payable increasing means you are preserving cash, right? Uh, because instead of paying cash right away, you paid with promissory notes, or they gave you credit sales. So you're preserving, even for 60 days, you're preserving, $2 million, and you can, from cash flow perspective, this gives you a lot of leeway, right? To use that cash for like 2 months, right? So it's not a bad thing. Notes payable decreased, right, by 16.67%. Notes payable are what? Promissory notes. So this, if promissory notes decreased by 16%, this is not necessarily a bad thing, right? It's a good thing. You might wonder, if the increase in accounts payable is a good thing from the cash flow perspective, isn't this also isn't this a bad thing from the cash flow perspective? Yes, this is not necessarily a positive thing from cash flow perspective because you cannot preserve as much cash, but this is a good thing in terms of default risk, right? If you have, think about it, if you have at least accounts payable is not the credit sale initiated by you, it was a credit sale offered by your vendor or supplier, right? So you're not paying any interest on it. But here, if you have a lot of accounts, notes payable, promissory notes payable, then you have to pay interest on it, right? So that's a financial distress, right? So if the promissory notes decrease, then from the debt management perspective and the liquidity perspective, it's not a bad thing, right? Now, there has been no change in total current liabilities. And then we move on to long-term debt, right, or non-current liabilities. That was a decrease in mortgage, right? That's a good thing. Your mortgage payment, as your mortgage goes down, your mortgage payment goes down too, right? It decreases your financial distress, financial burden. Bonds payable decreased by 7.69%. So think about it. If the bonds payable decreased, also from the debt management perspective, this is a good news because your financial burden, financial distress has decreased, right? Of course, you can say from the cash flow perspective, you have less your cash flow available cash flow is going down. So from the cash flow perspective, it may not necessarily be a good thing. But you don't have to you don't have to just narrow your focus on that only. Why? Because look at the equity. I mean, all this decrease in liabilities is more than offset by the increase in equity, right? So in other words, even from the cash flow perspective, you're not necessarily seeing lower liquidity, lower cash flow. You're still seeing positive, more, cash flow because there was more paid in capital from equity, and equity, you don't owe equity to anybody, right? That's your own capital. Your own capital has increased. Good thing, right? And if this has decreased and they all decreased, then that's a bad thing. But all of this decrease in debt is more than outpaced by increase in equity, right? And then eventually, therefore, your total liabilities and equity increased by 11.11%. That's what's important, because it has to balance out, right, with the total asset side, and it balances out, right? So this is called horizontal analysis. But now look, the term vertical analysis, horizontal analysis, that's very elementary, rudimentary, juvenile. I mean, just because it's going vertical and going horizontal, calling it vertical analysis, horizontal analysis. I mean, that's what they call. That's how they call it. But that doesn't look like a very intelligent name or mature name. I would say, just like common size statement. Remember the vertical analysis was called common size statement, right? Just like that, the horizontal analysis, this is the name I call it. I mean, I would like to call it intertemporal analysis, or diachronic analysis. Intertemporal means between two time points. Diachronic means across time, right? Two time periods, right? Doesn't it's not a big deal how you call it, but at least that's the way I look at it. And then this column F and column G are simply the vertical analysis or common size statement of both 2019 and 2018, right? So then it's not a big deal. You can simply, just like we did that. So all you need to do is just divide it by the total assets, but don't forget to lock, right, the denominator, right? And then you drag it down. Okay, and that's for 2019. And then you do the same thing, but be careful. I copied that over, right? And then so that's C32. This has to be 2008 total assets is in C32, 42, not right, B42. So I lock it and I drag it down. Okay, there you go. Okay, we got it. And then all you need to do is, now housekeeping. Okay, you need to make sure that the housekeeping is impeccable. these, garbages, you throw out the garbages, right? Wherever there is no data, you'll need to, you're responsible for cleaning it, right? You have to clean it. And then this is also part of the housekeeping, right? The borderline, you have to make sure you have the right borderline to make it neat and clean. Okay, so I don't, okay. I'll first put the bottom borderline. There you go. And then the here, you don't have conveniently only the right side borderline. So I will, oops, that's too much. I will put the whole thing, right? All righty. So that is our horizontal analysis. Now, next example. I'm going to skip this example and go straight to this example. This is the income statement, right? The one before that is also the income statement. Now, I want you to delete all the highlighted cells, okay? All the highlighted cells. So this exercise is kind of exercise of your, quick logical thinking, right? Or so first of all, you need to fill in those blanks, and we don't have. We have some clues hiding somewhere. First of all, how do you know what gross sale is? Gross revenue, right? Of course, if you knew net revenue, then net revenue is the result of gross revenue minus this, returns and allowances. But the returns and allowance is already negative. It's already in negative. So if you just simply add them up, you would get this. But then you don't have neither, right? You have neither. So then how would we figure out either one of them? We have no way to figure it out the way it is now, so we'll have to move on. But at least, oh, here's something we know. We can figure out what GAS is. What is GAS? GAS is goods available for sale, right? Goods available for sale is the result of beginning inventory, right, plus net purchase, right, minus returns and allowances is GAS, goods available for sale. But here, returns and allowance is already in negative, right? So that means if you just sum all of these, then that's GAS, right? But then, if you knew GAS, then from GAS, if you subtract these two, right, then you can get this. Because remember, we just sum everything, and then you will get this. This is already negative. That's why but we don't know GAS, so we don't know this. But at least we know what GAS is from these two clues, right? Why? Because from GAS, think about it. In chronological order, when you have goods available for sale, what does that mean? That's the all the goods or merchandise you have to sell for that operating period, right? And during that operating period, if you sold something, right, that sale is recorded as sales revenue, but the cost of that sale, cost of that revenue is recorded here as cost of goods sold. Isn't it right? So think about it. So and GAS is goods GAS is basically the inventory, right? Everything here is beginning inventory, net purchase, that's also inventory, returns and allowance, inventory, right? Ending inventory. CGS is also, inventory that was sold. In other words, the inventory is basically expressed in terms of price. Cost. In terms of cost. So therefore, we can find JS by, think about it. CGS is if subtract CGS from GAS, then there's ending inventory, right? Isn't it right? So if you add um, them up, right, uh, that would be GAS, right? But again, think about it. This is already negative, so normally, so you can, GAS minus CGS is ending inventory, or GAS minus ending inventory is also CGS, right? Now, and CGS, I've been telling you, CGS is the conclusion of this section. So you get to this from by subtracting from GAS, subtracting ending inventory, right? But ending inventory is already negative, right? So you add them up, right? You just add them up and you arrive at this. So that means to get to GAS, you will need to subtract this, then they add it because it's already negative, right? Then we got GAS, right? Think about so then what is net revenue? Net revenue is basically isn't net revenue the gross profit plus CGS, right? Why? Because from net revenue, if you subtract CGS, then you get gross profit. We didn't. We talked about gross profit in passing, and I told you gross profit can be misleading, right? Why? Because you're not really at profit just yet. Why? You just subtracted only the direct cost from the net revenue, right? So to actually arrive at, I mean, direct cost is not the only cost. The OPEX, operating expenses, right? OPEX is another part of the cost, or called indirect cost. So to really arrive at the operating profit, you have to subtract CGS and operating OPEX from net revenue, right? But then, simply, subtracting CGS from net revenue, this is only a half truth, right? It's only half truth. It's not the entire truth. So that's why I don't respect, or I don't hold gross profit in high regard. But anyway, they used gross profit here. So that gives us a clue to get back to the net revenue. So our net revenue is what? Then sum of these two numbers, right? CGS and gross profit. Okay, there you go. And then that is your net revenue. And you arrived at net revenue by adding these two. From gross sales, you added these two numbers, you arrive at net revenue. I mean, normally it would be subtracting, but since this is already negative, if you're adding, it's already subtracting. But that means to get back to gross revenue, you'll simply need to add them up. But since this is negative, to make them add, you must subtract it. Then negative negative will be positive. Okay, hit enter. So that is the gross sales, right? Or gross revenue. Now here also, so then what is the net purchase? Net purchase is the GAS minus returns and allowance, beginning inventory minus returns and allowances. So, but since this was already subtracted, right? So let me, there can be no negative ending inventory. This looks negative because you don't have net purchase, right? So if GAS is like this, what should be the net purchase? Will be like, this minus, oops, why is it doing that? So this and this. Now, subtracting this is correct. And you will have to add this back in, and this is already negative. This minus will, minus will be plus, right? So we got that. Okay, I see why ending inventory is expressed as negative here. It is to simply, adding them up, right? This is not really negative number. It's simply ending inventory is positive, but it was expressed as negative because by adding them up, it's going to be automatically subtracted. If this was not negative, to get to this, you would have to subtract, right? If this was positive, right? So anyway, we got that, and then next is what is the depreciation? To find depreciation, we would need to know operating expenses, OPEX, and the OPEX. And then once you find the OPEX, then subtracting all the others from OPEX, you'll get depreciation, right? But then what is the clue? How do we know what OPEX? OPEX is 15% of 100%. 100% is what? Net revenue is always the base of the common size statement in income statement. So what we do is we'll multiply this by 15%. That's this. And then what is this? Depreciation will be this minus some of these other things. This one is the only thing that is separated, but the others are in a contiguous range. So you can just highlight them. There you go, we got that. And then finally, then operating income is, now, normally you would get the operating income by subtracting CGS and OPEX from net revenue, right? But you can do it that way. But we already have gross profit, which is the result of subtracting CGS from net revenue. So here we will use this result. I will simply then from gross profit I will subtract OPEX, and that's our operating income. And if taxes are this, then your net income will be your EBIT minus taxes. And apparently this company doesn't have any interest payment, right? So there you go. Then we have completed our task, and the remaining, what's remaining? Oh, so common size statement. And of course, then all you need to do is, right, divide each line item by no, what did I do? Not that. Each line item by the net revenue, and you're gonna lock the denominator, so you can just simply drag it down. Okay, what about the, just copy that here and paste, and I will drag it down. I will drag it down like that and clean up later. Okay, and then there you go. And then the blanks, right? The housekeeping, right? You clean it up. Clean it up, right? A good housekeeping, right? So there you go. We have, oh, one last thing. Don't forget, give it by default, give it 2 to 3 decimal places, always. Always give it 2 to 3 decimal places. So I'm going to highlight that column, go home, and then give it 2 decimal places. So, okay. All righty. So we're done. So that's it for today for this segment. And I will see you in next class. Okay. End of video. And I'll